Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 25, titled Hitting a Double with Procter Gamble, using covered call writing exit strategies to increase portfolio returns. Now, as many of you know over the years, I've stressed the importance of mastering the three required skills to achieve the highest possible level of profits when we're doing our option selling trades. And those skills are stock selection, option selection, and position management. In today's podcast, we're going to focus in on exit strategies, the third of the three required skills, and specifically hitting a double, where we generate two income streams in the same month with the same cash and the same stock. So let's first talk about what hitting a double is. And that's a term that I borrowed from baseball. And what we mean here is we're going to buy back the option that we sold when we entered the covered call trade, which usually results from a share price decline. And then we wait to see if the price recovers during the contract. And if it does, we can then sell the same exact option, thereby hitting a double. In other words, two income streams, the first sale of the option and then a credit on the second sale of the option. Now, in order to do this, we have to implement our 20%, 10% guidelines, which dictate when to buy back the original short call. So in the first half of a contract, we set our limit order to buy to close the option at 20% of the original share price, and we move that to 10% in the second half of the contract when time value is eroding and there's less opportunity to generate additional time value profit. So if you could envision in your mind what such a trade would look like, I think you would understand that it would have a V-shaped pattern to it, a V-shaped recovery, where the price is up and then declines and then comes back up again. So let's use this information, and we're going to take a real-life trade that was executed by one of our BCI members with Procter Gamble. And that trade's on the New York Stock Exchange under the ticker symbol PG. Okay, so on 5/18, PG was trading at 116.21. So 100 shares were purchased. As soon as that was done, the call option was sold. The 1 month out, 6/19/2020, out of the money, 117 call, and that was sold for $1.40 or $140 for the contract. Now, 8 days later, PG dropped in price, and we were able to close the 117 call for 30 cents, which approximates our 20% threshold. 20% of 140 would be 28 cents. So since it's a guideline, it was closed at 30 cents. Very good. Now, 2 days later, on May 28th, the price of the stock went back up. You have that second leg of the V, that V-shaped recovery. And what happened? The 117 call was able to be resold at $1.90. Even more money than was received 10 days prior to that. And that's because the price had gone up significantly. So if we were to take a look at a chart of PG during that time frame, you would clearly see a V-shaped pattern where the stock price declines and then quickly recovers. So the hitting a double strategy is normally reserved for the first half of a contract, although there are exceptions where we can hit a double in the latter part of a contract. I even have hit doubles on the last day of a contract in very, very volatile markets. Now, if we were to look at a price chart of the option itself, the 117 call, it would look exactly the same with that V-shaped pattern, where the price of the stock option went down, and that allowed us to buy to close at the 20% threshold, and then went back up again, which allowed us to then generate additional income. Now, if we feed this information into the multiple tab of the Ellman Calculator, those three steps, the initial sale, the buy to close, and then the sell to open, it would look like this. Initially, the 116.21 stock was purchased and the 117 call was sold at $1.40. Well, that represented a 1.2% 1-month return, initially anyway, with an opportunity for upside potential of 0.7% if PG went from 116.21 up to the 117 strike. There's an opportunity there for 1.9% initially. Now, when the option was closed, we spent 30 cents. So the net option credit went from 140 down to 110. At this point in time, the return on our option dropped from 1.2% down to 0.9% with that very same 0.7% upside opportunity. Max return at that point was 1.6%. Now, a few days later, the actual option was resold for $1.90, bringing a net option credit up from 110 to $3. So it went from 140 down to 110 and up to $3. At that point in time, our return on our option was 2.6%, more than double the 1.2% we had when we started the trade. Upside potential was still the same, 0.7%, the max we can make because we have an obligation to sell at 117. And that's where we are after the second leg of the hitting a double trade, where we have a max return of 3.3%. Initially, if you recall, it was 1.9%. So to summarize, exit strategies are critical to enhance our portfolio returns. We must take advantage of every opportunity that comes our way. Now, using the 20%, 10% guidelines will almost automate the process regarding the initial exit strategy step when the price of the stock declines. We can enter that buy to close order immediately after entering the trade. And then if that threshold is met, the option execution will take place. We'll be notified by our broker, and then we can decide on the next step. And the Ellman Calculator can be used to monitor the trade status. So there you have it regarding BCI podcast number 25. For additional information, visit the Blue Collar Investor store. And we have multiplicity of books, DVD programs, calculators, and so much more to enhance the education process regarding covered call writing and selling cash secured puts. On our website, we have a lot of free resources. You could sign up for the free BCI newsletter on the blog page of our website. Just fill in the form on the right side, and you'll receive our free newsletter every week, 10 a.m. Eastern Time. Every one of these newsletters contain articles. It takes me a few hours a week to write these, and they all have an educational component to them, and they're free. So I want to thank you all for taking the time to listen to this podcast. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.